We put out a note on Tuesday because things were looking a little bit bleak last week, I'd have to say, because you'd have great earnings reports and terrible price reaction in the market as a whole. But we did some work on near-term catalysts on bonds, and we saw everything really lining up for rally. So far we've been correct. And what we're really focused on is global growth, mostly in Europe, and nobody really ever reports on it, but you can easily get it on the terminal. That's where we get it. The European data is just awful.
Yep.
They're in a recession as we had predicted. Mild so far, but it's only going to get worse. The ECB raised rates twice during the quarter, so nothing better is happening.
Yep.
And if you look even today, the unemployment is rising in Spain and Germany. They'd have the final manufacturing PMIs 43. So that's bad. But also we had a weak PMI, which lowered our Atlanta growth rate. And then the final point is that, and we focus a lot on oil, is that it's not well discussed that gasoline prices came down 10% in a month. So it's 120% annualized. That's a little bit exaggeration, but still that's going to show up in not just headline CPI, but more importantly core. And this is what the Fed misses, and this is why they have all the nonsense from the 70s, because the real problem in the 70s, we had a 1,200% increase in oil prices. It bleeds through to core. So we're going to probably have cool CPI print in a couple of weeks, and PPI definitely. And so this whole narrative that we're going to like 6% bond yields should attenuate. Having said that, we think that rates will really rally when the ECB starts cutting rates in the first half or even the first quarter of next year.
So you think they're going to cut imminently? They do have a two-handle on inflation. You know, even maybe because they're in a recession, or maybe because inflation was transitory-ish. We were talking to Cam Harvey yesterday. You know that guy? He's a professor at Duke.
Yeah, excellent.
And he was making the point that you have been making for a while. He said, look, it's ridiculous that this Fed thinks inflation is still, 3 to 4. When you take out the rent equivalent, which is backwards looking in the wrong way to do it, we're under 2. And I immediately looked at your CPI-R on Infrastructure Capital Advisors on your website. And you guys have 1.3% right now. So explain to us how you calculate that. You use core CPI, and then you take out the rent equivalent part, and you put in Case-Shiller, right?
Correct. You can basically do it in your head.
Yeah.
So because
not my head. You can do it in your head.
But it's kind of nutty, but the CPI still is saying shelter's 7.2%. When it's actually going up a little bit, to be fair, but it's not likely to skyrocket. But so just assume 0. Case-Shiller has been close to 0. So 40% times 7 is like 3%. So basically CPI is headline is overstated by 3. And then it's only 33% a core. So it's overstated. Core is overstated by about 2.1%.
So, but so inflation isn't as bad as we think it is what you're saying. Still, cumulatively, it sucks, right, for consumers, especially since wages.
My New York strip is still killing me.
I don't feel like wages have kept up. Certainly mine haven't. And then growth, though, looked incredible, backward-looking, right? 4.9% in Q3. How does it look to you going forward? Because I feel like the consumer is getting hurt here, and charging everything and missing payments.
Well, no doubt. We have a saying that the average consumer is not an economist. So what we mean by that is they don't really care about CPI, whether it's R or whatever, because that's for 12 months, but they do care about 24. So prices have still skyrocketed over 24. And if your wages didn't go up, which is true for a lot of lower income consumers, and you don't own a house, you're definitely under pressure.
And by the way, CPI-R was much higher than core CPI for a while.
Correct.
Because I look back on the table and you guys were up at 11, 12%.
Yeah, this is why we say the Fed is incompetent, because they just weren't even looking at any data. Like you can go back and say, look at PPI is actually reported. It was at 11 when they said things were transitory. So they need to redo their entire framework. And everyone should go look at the way the CPI shelter is calculated. It's ridiculous. They only update it at 1/6 every 6 months. So it's just designed to be lag. So the Fed should correct for that. In fact, the San Francisco Fed does correct for that.
But why? I just don't understand why they don't. I mean, for all the flack that Druckenmiller gives Janet Yellen, she's a super genius, right? And she's an economist,
Right.
PhD.
Yes.
Like, she's not. Now she's like a government, political kind of a hack. But she was like a serious economist.
It's inexplicable, and I'm shocked that not on this program, but other media outlets, that everyone comes on and says, not the Fed, but other people, that inflation's sticky when it's just flat out not sticky. It's actually contained. It has been since July of last year.
Have we seen then peak rates?
We definitely, there's not going to be another increase. And now, for the first time, we've been saying, I think,
to the federal funds rate, right?
Yeah, we've been saying for 4 or 5 months the Fed wouldn't increase rates, but they don't know it yet. Now they know it. Now they know it after this employment report. Very cool wages, rising unemployment. So that's what they look at, even though that's a flawed leading indicator. So the Fed is clearly not going to raise. ECB is not going to raise. They're going to cut. But, all this really is going to start to impact, because we're worried about the liquidity, trillion. That's the other data we look at that most people don't. Global monetary base or supply, global liquidity really from central banks, down $1 trillion over the last 2 quarters. So it's terrible. That's probably not going to turn around until next year when the ECB is forced to cut. Because, that's a simple way to trade the market, right? It's like if the Fed intervenes during the pandemic and says we're going to increase the monetary base by a gigantic amount, you get long. If they're sucking money, it's like taking $500 off free parking, if you're playing Monopoly. All of a sudden, if you put it on, then all of a sudden everything's overinflated and everything's go-go, you take it off and it's bad. So we're in the takeoff phase, but I think we overshot to 5%. We'll see if we keep rallying from here at 4.5%, but next year we're confident we'll get below 4, so we'll meet our 5,000 target next year at least.
But so you don't think like the bond vigilantes will come back and say, we're not going to finance this kind of deficit spending much longer?
We think there's
not this rate.
That's a great question, because we think there's way too much focus on the U.S. budget deficit. Because, I don't know.
And Matt is concerned about it. So, are you going to try to allay his concerns?
Well, I think it's terrible from an economic growth perspective, because there's something called crowding out. So, if the government spends money, it can't be invested.
Well, if they spend $900 billion next year servicing the debt, we're not going to have enough money to spend for the next pandemic.
No, it's a horrible thing, and it's a waste of capital, and it's terrible for economic growth, terrible for everyone. But it's not enough to drive global interest rates up 100 basis points. That's my only point. At the margin, it's bad.
Yeah.
But keep in mind that our Fed, strangely, if you look at the balance sheet, is actually still monetizing part of the debt because they're unwinding their short-term borrowing. So it can't be true that that's the key driver of global interest rates. It's bad. It's a terrible economic policy. Obviously, the budget process is horrendous.
And for taxes, dude, because now every time someone wants to cut taxes, they're going to say, we can't afford to. We got to do entitlements. We got to pay for the military. We got to pay $900 billion of service debt. So Miller and the rest of the middle class is going to have to pay half.
No, it's horrendous policy. And in fact, we're actually pretty bullish about China because they save 45% of their GDP. So savings and investment drives economic growth. That's the only thing that does it. And that's just intuitively obvious. So if the government is reducing savings, we're going to have lower growth in the long run. So it is terrible, but just not enough to drive global rates to 6, 7, 8%.